Have you seen your showings coming to a complete halt in this market? Well, today I'm discussing with Josh Jankelow from Olympus Financial on what you can do to generate more traffic and get a whole lot more traction on your listings, and not only get more traction, but ultimately make more sales. So today I want to cover three main points, which the first one is attracting more buyers. Second, we're going to discuss this whole talk that we keep hearing about buy downs, 2-1 buy downs, permanent buy downs. We'll get to the bottom of that. And the third point that we're going to discuss is touching on the main differences between conventional and FHA, and to see which one is right for your buyer, or if you're looking to buy yourself, which one is right for yourself. So with regards to this market in Miami, I have condos in the market that have been for sale for 30 to 60 days, and we've probably shown once or twice in 30 to 60 days.
Wow.
And these are properties, Josh, that they're priced extremely well, great views, perfect line, everything that a buyer would want. But obviously buyers are very hesitant with condos in general, which we can get into a longer discussion about later. But again, it's because of the condo market. Single family homes are also selling. So what clicked in my mind the other day, Josh, is what are other agents doing to drum up traffic for their listings? So I had this wonderful idea, right? I thought to myself, let me see what other agents are referring to attract buyers, because as you all know, with this NAR ruling, commissions can no longer be part of the MLS listing. It's been removed.
Right.
So since that commission is not there, how do you do it? How do you attract more buyers, a larger audience, when you can't even advertise the commission? No mention of the commission in the description or in the compensation field for agents. So I said, let me check out to see what other agents are doing. So I looked in Dade County, let's say everything that's active under contract, that's closed, and I searched for the word buy down. So this is one of the tips for the day. I looked for any description that had the word buy down in there, and I started seeing what agents were putting. And I started noticing that very few agents are really marketing buy downs. But the agents that are marketing buy downs, they have a great relationship with a lender, and they've come up with some kick butt language on how to attract more buyers. So, Josh, as far as this whole buy down enticing buyers, do you have any thoughts on, again, trying to get as many people as you can into listings with this market that's dramatically slowed down here?
Oh, without a doubt, Chris, it's something that I've been preaching kind of since this spike that we've seen over the last 2-3 years, let's say, right? And it's, in my mind, when we're in a market that we believe is at a high, or where we believe rates will improve, these temporary buy downs can be very attractive, right? We could do a deeper dive as we get further into this discussion about the differences between a temporary and a permanent buy down. But particularly right now in this market, it's very attractive, right? If a reasonable market rate for a very well qualified buyer on a conventional loan is in the mid to high sixes, let's say a 6.625%, with a temporary buy down, this buyer could access rates, at least in the initial year, of a 4.625 or even a 3.625. So even though it's temporary, from a marketing perspective, those numbers can be very attractive, right? Outside of the fact that in a market that's improving, these temporary buy downs really are a safer bet than the permanent buy downs.
Josh, if you don't mind, and sorry for interrupting you, let's talk about the difference with the 2-1 buy down, what in the world a 2-1 buy down is, and what a permanent buy down is. Because again,
right,
I was in the mortgage business for many years, and I'm still licensed now. I guess this is all lingo jargon that us in the business, we kind of, we expect everybody to know about it. But if you could just get into the detail on the difference, what exactly a 2-1 is, and what the permanent buy down, what the difference is.
Absolutely. I think it's great. Let's, start from day one, right? A mortgage rate, very much like the game of golf, has a term called par, right? And what par refers to is an interest rate that is essentially even. It's based on your credit score. It's based on your down payment or LTV. And it can be based on your loan amount as well as property type, a couple other factors, right? But very scenario specific. A par rate is one that you are not paying anything to originate, anything outside of standard costs, and you're also not receiving a credit, right? So let's say you have a par interest rate based on your scenario, Chris, of a 6.625% in today's market. You're not paying any origination or discount points. In other words, you're not buying your rate down. That is what the bank's offering you for free, right? You have methods to go ahead and lower that rate if you like. One and very traditional method is called buying points or buying your rate down. It is a permanent idea, right? And what that is the bank saying, hey, Chris, you have excellent credit. You're very well qualified here. We are going to extend you lower rates in exchange for a one-time premium, right? And you could keep this lower rate for the full 30-year term, but we're going to have to charge you a little upfront today. And, points, each point that you're paying represents 1% of your loan amount. And typically you'll be limited as to how many points you can buy. Anywhere from 2 to 3 points usually will be your limit in terms of a high price mortgage, right? There's a points and fees test. There are other third party items that factor into this, right? So it's not just about the loan and the points, but that's a pretty good estimate. The thing with points is once they're bought, right? And so I'm going to get a little technical here. If you want me to slow it down or change angles, just let me know.
Cool. So to just summarize, par basically means you don't have to pay discount to obtain the rate, nor are you obtaining a credit from the lender. So it's right there in the middle. And the discount points is what you have to pay up front to obtain a lower rate. So let's say that the rate is 6.625 and today is December 12th. So with full disclaimer, depending on what you qualify for, property types, all of these different characteristics and qualifying guidelines, let's just say 6.625. And we ran a scenario the other day, Josh, where I believe it was if somebody were to pay 3 points, the rate was like 5 3/4, 5 7/8, somewhere along that line. So what the real calculation is, and correct me if I'm wrong here, Josh, what the real calculation is, let's say that you're getting a $600,000 loan and it cost you 3 points to obtain that 5 3/4 rate, just to use a number. That's $18,000 that you're paying up front. So if you're going to save, let's just use another round number, Josh. Let's say it's $300 is what you're saving every month, but you had to pay $18,000. So if we were to get the $300 divided by $18,000, and that would be what, 60 months to be able to break even on what you gave up front. So, Josh, buying down points, and I'm going to have to throw you the lob on this one. Buying down points is intended for the short-term loan or the long-term?
Well, that's definitely a lob. In my mind, right? It's definitely personal, right? But from a financial standpoint, I think it makes infinitely more sense to keep that for the long term. If you're going to stay in a loan for 10, 15, 20, 30 years, pay the mortgage off, buying points makes sense. In the long run, you'll recoup that initial investment and save much more. In this example, 5 years. 5 years is a long time in my mind in this market.
Right. So beginning month 61, that's where you begin to see the savings for the monies that you paid up front to obtain that lower rate. I think we're pretty clear there on the permanent buy down. Now, if you could just jump back into what the 2 means in the 2-1 and what the 1 means.
Great question, Chris. So the 2 and the 1 in a 2-1 buy down stand for 2% and 1%. And how a 2-1 buy down works is for your first 2 years of the mortgage, you are going to have a heavily discounted rate. In year 1, you'd be 2% lower than your full note rate. In our example, we had our client at a par rate of a 6.625. In year 1, he would be paying a mortgage based on a 4.625, 2% lower. In year 2, he would be paying a mortgage based on a 5.625 or a full 1% lower. Starting in year 3, he returns to his full note rate. Now, it's short-lived, but you could see in the short term, the savings are much greater than you would be able to attain with buying points on a permanent buy down, right? In the example you had just mentioned, it was about 3 points just to lower your rate by about 1%, right? And that's not always the case, right? Sometimes that could lower your rate more, sometimes it could lower your rate less. On our scenario that we priced, that's where it was. But you're not realistically buying your rate down a full 2%, right? And so these products really make sense in a market where we are anticipating rates dropping in the near term, where we might be able to refinance into something more attractive for the long term without the costs of paying points. Does that kind of make sense?
It does. And I think that the reason why we're hearing this whole 2-1 buy down, that it keeps popping up, we're hearing about it more and more, is because this savings of 2% for the first year is dramatic, right? It's a lot of savings for the buyer. And Josh, what is the average cost for this 2-1 buy down? Just throw me a number, whether it's 1%, 2%, 3%, whatever it is.
Typically, you're looking at between 2 and 3%.
Okay, so between 2 to 3%. So to pay between 2 to 3%, again, a $600,000 loan, that could be anywhere from $12,000 to $18,000. So you say to yourself, to save a few more $100 per month, is it really worth that 2 to 3%? And again, this is me playing devil's advocate here, Josh. Is it worth paying that difference of money? And the thing is that since the inventory has increased in this market by so much, buyers typically are not paying for that 2 to 3%. Who's paying for that buy down is the seller. And the seller's doing it to entice as many people as they can to put an offer on their property, because their property is tied into a significantly lower monthly payment, even if it's just for the first 2 years, because the buyer did pay for it up front. Now, another option, Josh, what we could, that some people are doing or thinking about is, instead of getting that $12,000 to $18,000 credit to reduce my mortgage payment, what if I apply that $12,000 to $18,000 towards my closing costs, right? So it's like, if you have this wad of cash, right, that you can use for whether it's for the closing costs or for this 2-1 buy down, you say to yourself, okay, I'm going to pay $300, $400 more per month. However, I'm coming to closing with $12,000 to $18,000 less. And you know what? This property needs a new kitchen, needs some new flooring. Let me just use that money to do those improvements and somewhat bite the bullet with the mortgage payment. I mean, Josh, what do you think about that calculation there?
Look, it's entirely accurate, right? If we're going to be very candid, a 2-1 buy down is essentially a seller credit, right? It's all it is. It's used to help you pay a lower interest rate temporarily, but you're not actually receiving a lower interest rate. How it works is the seller credit goes into an escrow account, and that escrow account makes subsidy payments towards your mortgage every month, so that every single month, based on where you are at in your 3-year term or your 2-year term on your buy down, you will make a subsidized payment. The escrow account will make the other rest.
So, Josh, let me understand this. So that money that's paid up front for this buy down, the 2-1 buy down, this, let's say the $12,000 to $18,000, how does that work? I mean, what is done with that money? Is the mortgage company paying for the difference? I'm just curious about the logistics of where that money's actually going.
Very, very good question. So that money is actually functioning as a seller credit, but only for the purpose of lowering the buyer's payments, right? So that money is actually sitting in a separate escrow account, just like taxes or insurance might be. And in the first year, Chris, when our client is making payments based on the 4.625, his real rate is still a 6.625. The difference is coming from that seller buy down on a monthly basis, right?
Okay, so in that escrow account, if they're saving $400 a month, the bank and that escrow account takes $400 a month, right, for the first 12 months. Then if the savings the next year are $200, then they use the $200. Okay.
Perfect. Exactly. Now, the beauty with these temporary buy downs is if we're of the belief or understanding that more than likely interest rates are coming down and we're going to refinance. If you refinance before that escrow account is empty, you will get that balance back, right? If you're buying points in the long run,
Josh, I'm sorry. I'm going to have to interrupt you. I'm not going to apologize for interrupting you. Can you please say that again so that whoever's listening to this fully grasps what you just mentioned?
Please.
I'm going to ask the question. So if the person refinances, let's say on month 10, where does that money go that's in that escrow account that's being set aside to subsidize their mortgage payment? Who gets that money?
The current owner.
That's huge.
The money comes back to the buyer or the client just like it would in a seller credit, right? It's never a gamble with these 2-1 buy downs. When you're buying points, I don't like to say the word gamble, but it is. You're betting on which way the market's going.
It's speculative, right? That's really the only word that I could use. It's speculative. That was like, way back when there were these whole neg am coffee index type of loans that the person would pay whatever it was, 0.5% a month, 1% a month, and you have all this negative amortization, all this money being owed. So after a year, you can owe $5,000, $10,000, $20,000 more on your mortgage balance. But that was for the very savvy person, right? In the sense of where whatever monies that you're saving for that type of neg-am loan, whatever monies you're saving, you have to reallocate and use that money to your benefit. Because if you're just using it to live on less, you could be shooting yourself in the foot.
Right.
Yeah, anyhow, that neg-am is and I'm going off of a script here. But that neg-am loan, that shit was crazy.
It's a good thing that they don't exist anymore.
No, they don't. So
they were rarely used by the consumer who was savvy. It was typically by a consumer who needed that initial lower payment to feel comfortable.
Correct. So what I feel here, Josh, is that this 2-1 buy down, with it being speculative, correct? If you don't refinance it in 2 years, you can't get any of the cash back, obviously, because that money was used to subsidize your payment. And then depending on which direction rates go, it either makes sense to refinance or not. So I guess that's kind of the catch with the 2-1 buy down. The 2-1 versus the permanent, because the permanent, as it states, it's permanent. So for the life of the loan, if you pay 3 points, which just the thought of paying 3 points, Josh, I'm going to be honest with you, it almost makes me sick to my stomach. Right?
It's a lot. Look, it's a lot. In this market, it's a lot. In any market, you could argue that it's a lot. If rates were back at 3% and those 3 points were getting you to a 2.125, and this is your forever home, that's, hey, maybe we could make it make sense at that point. But yeah.
It's a lot. It's a lot of money, right? It's a lot of money. And me as a buyer, each person has their way of doing business. Me as a buyer, before I put, using that $600,000 example, instead of using $18,000 to temporarily buy down a rate, I'd much rather use that as a contribution for closing costs or using it as money for improvements once I close on the property, because it's very short-lived. However, going back to the core of this podcast, we're trying to figure out how to incentivize buyers to purchase one of your properties. And that's the main reason why we're even having this discussion on 2-1 buy downs. It's because sellers are trying to figure out, how do I get more people to show my property and ultimately sell it? This is one tool. You either use a 2-1 buy down, you offer the buyer monies for a permanent buy down, or you just straight up give them a contribution for closing costs. If they're financing, if they're not financing, if they're buying cash, then you just give them a discount in the price.
Look, 100%, Chris. And I think it's important to mention that the nature of these temporary buy downs is they have to come from a party that is not the buyer, right? An interested party. That can be the seller themselves. It could be the seller's realtor. It could be the lender, right? Any other party that's related to the transaction outside of the buyer. And so this actually offers a tool more than just to the sellers, but to the agents representing the sellers. Let me restate that. This temporary buy down functions as a tool not only for the sellers, but for the agents and team representing the sellers to all be involved in making this listing more attractive, right? Sometimes the seller might say, hey, I'm happy to pay 3%. In this market, I've seen it a ton. Hey, as a seller, you get me full asking price, I'll give them a 3% credit, right? Boom. Easy, nice offering with a temporary buy down. Sometimes it's, hey, your listing's been sitting for a while. You and I have a long-standing relationship. I know if I take care of you here, you're going to refer more business to me. So I'm working with my preferred lender, Josh Jankelow from Olympus Financial. That is a shameless plug there, Chris. And we both contributed 1% each. Meet us, match us, and we'll offer a 2-1 buy down and make this a whole lot more attractive for buyers in today's market, right? So that's my feedback. That's on how it's not only important as a marketing tool for sellers, but as a marketing tool for real estate professionals. Really.
And really everybody wins at the end of the day.
Correct.
Everybody in the most important people in this transaction, contrary to what people are thinking right now, I'm not going to say the agents. The most important people in this transaction are the seller and the buyer. The seller is able to move on with their life, close this chapter, move to wherever it is that they're looking to move to, whether it's out of town, whether it's a bigger home, smaller home. They accomplish their goals. The buyer gets the space that they're looking for. And the agents obviously benefit for bringing both parties together. But it's a way of 100%. Making a deal happen. And I appreciate you making the distinction that this buy down has to be paid for by the seller. So a buyer cannot pay for the buy down?
Legally cannot happen. It has to be paid for by the seller or other interested party, right? So again, right. Seller's agent, lender, you get the idea.
If I'm a buyer, Josh, I can almost guarantee you, if I'm a buyer and I have to pay 3 points for a 2-1 buy down, I'm not doing it.
It doesn't make sense.
It doesn't make sense.
It doesn't make sense.
Right.
Why not just keep your money?
If I'm looking at 5 properties and one of the sellers is offering me, they're throwing in this buy down to entice me to grab my business, hell yeah, I'll take that 2-1 buy down all day long, or the contribution for closing costs. But that's an incentive that the seller's willing to offer based on where we presently stand. So Josh, I'd like to transition, and I feel like this whole FHA conventional conversation, we can be at this one for an eternity. But just with the highlights, what would you say is the difference between FHA financing? Because I know we've heard ad nauseum this first-time home buyer package, home buyer program.
Oh man!
So what's the difference with the conventional and the FHA program?
We could go down a rabbit hole here, and I'd love to do another episode where we do a really, really, really deep dive, right? Both are great programs. They are considered qualified mortgages or traditional mortgages, right? There are some differences. There are some differences in flexibility with debt to income ratios. There's some differences in loan amounts, and there's differences in down payments, right? FHA across the board is for primary homes only, and you can always go as low as 3.5% down, whether it's a single family all the way up to a 4-unit multifamily, right? As long as it is owner occupied in one of those units, 3.5% down. FHA and conventional will both have loan limits. So FHA has just increased their loan limits, and for this upcoming year, on a single family, it's $621,000. This loan limit goes all the way up to almost $1.2 million for a 4-family. It's at $1,194,250, right? That's with 3.5% down. So in theory, FHA loan, $35,000, $40,000 down, you're getting more than $1 million property.
Josh, if I could make a disclaimer here.
Yes,
this
sir.
Loan limit, is that based on a national price? Is that state? Is that based on county? How is that number determined for our audience?
That's a very good question. It's based on the majority of states in the US. There are counties and states that are considered higher price home limits, and those counties will have their own individual limits that are raised, right? This would be your bare minimum, but pretty safe for the majority of home buyers in the US to refer to those limits.
Okay.
Um,
Cool.
does that
So
make sense, Chris?
loan limits have been increased for conventional and FHA.
Yes, they have.
You had talked about the 3.5% down. Every time I hear the 3.5% down, Josh, maybe it's just me. I think, yes, that's great. You didn't tell them what the catch is though with FHA, Josh.
Well, there you
Come
go.
on, let's put our cards on the table, right? What is the catch with that 3.5% down? Now, again, my job is to play devil's advocate here.
There's a big catch, if you will, right? And look, again, FHA makes sense for some people. It doesn't for others, right? But with FHA, you have mortgage insurance, and you don't just have monthly mortgage insurance for the life of the loan with a down payment like that, right? So for the life of the loan, you're paying mortgage insurance. You're also paying 1.75% of the loan amount as an upfront mortgage insurance premium. It's almost like paying 2 points not to lower your rate. And, the beauty of it is that they finance it in, but it's still there, right? It's eating up your equity.
You sell you sell it well. The beauty is that they finance it. I love that. So it's almost 2%. So if a person's buying a $500,000 property, right, more or less, they're paying 2%. So that's $10,000 that they're financing on top of what they thought that they'd be financing, and the mortgage insurance. So conventional and FHA, conventional and FHA, correct? You're going to have monthly mortgage insurance for the both of them. FHA has the upfront mortgage insurance. And how long does the FHA mortgage insurance last versus the conventional mortgage insurance as far as to your ability to kick either one, to eliminate it?
Well, it's a really good question. The common answer you'll hear is that FHA mortgage insurance is for the life of the loan. There's an asterisk there. If you put 10% down or more on your FHA loan, you only have mortgage insurance for 11 years. On a conventional loan, you have mortgage insurance until you're at a 20% equity position, right? So if you put 5% down, or a lot of people didn't know this, on a conventional loan, first-time home buyer could put 3% down. Mm-hmm. You put 3% down. Once you make enough payments into your principal to get you to a 20% equity standpoint, you can request that they cancel the mortgage insurance. At 22%, the bank will cancel it automatically.
Which is a big deal, right? Because if you're in an appreciating market or you got a great deal, let's say 6 months, 12 months, and maybe, can I even say 6 months? Is that even possible? Can a person eliminate mortgage insurance such a short time after if they can prove that the value, let's say they made improvements, the market just skyrocketed, whatever the case is. Let's say 12 months.
That's the asterisk, right? Yes. Can they prove it? If you can prove that you've done improvements in that amount of time, you can absolutely have mortgage insurance removed. If you can justify the price. You can also always refinance where you have an appraiser go out and show an appraised value of more. You'd need to wait at least 6 months there. The other thing to consider, right, and I just had this aha moment, like, make sure to mention this, Josh, when you were talking, is mortgage insurance and why it's such a big deal is it effectively increases your interest rate as far as I'm concerned. It does increase your APR.
Correct.
Right? People get attracted to FHA, and again, they're great products. There are people that simply cannot qualify conventional or just scenarios where monthly is so much more important to them that it makes sense. So everyone's financial situation is different, right? But if it's just I'm attracted to FHA because it's a lower down payment, if you've owned a home before, obviously, and a much lower rate. That's what I get all the time. Much lower rate. It is a much lower rate. But when you take into account the mortgage insurance that's permanent and what that does, it's actually a higher APR, if that makes sense. So
it's just so lengthy, the amount of time that you have to wait to eliminate it, where conventional,
minimum
it get
11 years, if
right.
it's doable.
Like you said, there was an asterisk with the conventional on being able to kick the mortgage insurance. There's an asterisk, so it's I forgot which movie it was when the guy said, "So you're saying there's a chance, right?"
That's Dumb and Dumber. Dumb
Yes.
and Dumber.
So you're saying there's a chance, right? So at least you have the chance with a conventional, where with the FHA, you have to sit tight. In my experience, Josh, the times when an FHA loan makes sense, it's because it's almost the person's only option, right? They don't have the 760 score. They don't have, right? They're
I
not
gotta.
the ideal vanilla buyer, right? The person that has everything in line. It's their scores are 620, 640. There's a little ding here, there's a little ding
If
there.
they're listening to their team, financial advisors, yes, 100%. And I have to say, if they listen, right? Because again, it's a personal decision. I can tell you a real life scenario where we didn't just have a well qualified conventional buyer, but he was a first time home buyer and he qualified for a particular product that gave him a $5,000 credit, 5,250 to be exact. It gave him very discounted mortgage rates and very discounted mortgage insurance rates on the conventional loan with 5% down. He asked for FHA options. And when I gave him FHA options, he said, hey, the monthly payment's a little lower here. This makes more sense for me. And I tried to explain, you're financing another $8,000 into the back end of your loan versus receiving $5,250 from the lender today. It was a $70 a month difference. So we're talking about a $13,000 swing in his equity. And I'm pulling up a calculator here because I am a mortgage guy. Over $70 a month would have been 185 months or 10 years that he would have to stay in his mortgage, right? So, sorry, what am I saying? 10 years. It would have been 185 months, Chris, or 15 years he would have had to stay in his mortgage, right? So, to me, it made no sense, but that route made sense to him. And it actually, true story, didn't work out well for me. He felt that I was not moving in his best interest because of the $70 a month. And so we work to paint the very best picture for our clients. And it is, my duty is a fiduciary duty, right? I need to look out for your best interests.
What do you mean you don't get it? What do you mean you don't get it? These are the numbers. This is how it works out for you. I still want FHA.
That's it.
Okay.
And then you got to keep in mind, more than likely, FHA, conventional, whatever you closed at in the last 2 years, more than likely you're going to refinance in the next year or two. There's just no way around it, right? And so when you take that into account, I really predict that in this scenario, he's going to refinance in the next year and have buried $8,000-9,000 of that upfront mortgage insurance premium. And whatever else he paid in origination or points for that rate, as well as new title work, it makes no sense. If you went the conventional route, that credit was almost enough to pay for all of your closing costs, right? So it was just it's just how it works. But I'm sure you've seen scenarios where you've given advice that wasn't taken either. It's part
Correct.
of the game.
It's extremely frustrating, because you're showing the person on paper, this is the benefit. And not to mention, if he held on to that loan for any amount of time, how he's going to continue paying the mortgage insurance. If you can kick it with the conventional, can't do it on the other side. It's more expensive up front. I mean, with all things being equal, if you have a first-time home buyer plan loan with FHA, it's 3.5% down. Conventional, again, if you qualify, 3% down. So it's actually 0.5% less. You don't have the upfront mortgage insurance, and you can get rid of the mortgage insurance once you have 20% equity in it.
Yeah.
So Josh, aside from someone looking to FHA because of their credit score, what's another reason why somebody would even consider going with this FHA option?
Well, look, you did mention it. FHA credit score is a lot more flexible, all the way down to a 500, right? That's number one. But
Wow.
number two is FHA actually does allow a higher debt to income ratio than a conventional loan would allow, right? So if you are having trouble qualifying for a conventional loan, maybe because you have external debts, maybe you got student loans, which have now put you in the job you're in today, maybe it's a new car, maybe it's outstanding credit cards, whatever it might be, FHA will allow for a higher limit on that end. So it could be more attractive to a buyer with some debt as well.
So the first ratio is, let's call it housing, right? Which it's everything to do with the home, specifically principal, interest, taxes, and insurance and association. And then the second calculation is what I just mentioned there, principal, interest, taxes, insurance, and association, plus all of whatever debt is showing up on your credit report. Correct. So
Correct.
FHA allows a higher total ratio than conventional. So it's basically your scores aren't there. You don't have high scores, or you potentially have higher expenses than you do with conventional. So that would really be the only reason. The two main reasons why somebody would even consider an FHA is because of scores and the ratios.
Again, from a logical perspective, from a financial perspective, from someone who's a veteran in the real estate industry, I would agree, right? But some people, are in unique scenarios where it could be very payment sensitive, and this route just has a realistic payment that they could get into that they can't get into on a conventional, even if it's more money upfront, or even if it's more money financed into the home. There are scenarios in unique situations that may make sense, right? Again, it's my job to look out for the long-term future. And I say this all the time, but I'm very thankful, Chris. Thank God at this point in my career, one mortgage can't change my life, right? No matter what, if it's a $10 million loan, if it's a $50,000 loan, it can't change my life. I'm in this to build long-term relationships. If I look out for my client's best interest financially, and over the next 5 years, I've now saved them money, I've put them in their best position they could be in, they are going to come back and refinance with me, and they're going to come back and buy their next investment home with me, and they're going to tell their colleagues, neighbors, friends, family, Josh was honest, transparent, and really looked out for my long-term goals and has made me successful. That's going to bring me a lot more business and build a long-term relationship that can change my life. Right. So I like to lead with that strategy, but it's a very personal decision. A lot of people want your help and advice, and some people just want the bottom line and want to make their own decisions without any input. And so it's a fine line to walk.
It's, as you know, it's basically a loan comparison. This is what FHA, conventional, these are what both, the down payments, closing costs. This is a side-by-side comparison. You decide what you want. I remember when I had my mortgage business, Josh, I would tell a buyer, for example, look, you qualify for this amount of money. Okay, so let's say they make, I'm throwing a number at you. Let's say they make $9,000 a month. Their mortgage payment's $4,000 a month. I tell them, look, can you afford the $4,000? Yeah, I can afford the $4,000. I make $9,000. All right, great. So you gross $9,000. You probably net 80% of that, more or less. You're grossing $7,200. Your mortgage payment's $4,000. You have utilities, car insurance, all of these other expenses. So even though someone qualifies for a mortgage, the reality is, how much disposable income do they have? And that's the conversation that I typically would have with buyers is, you qualify for this, but can you swing this from now until let's say it could be 5, 10, 15 years down the road. How comfortable are you with this payment? Because if you're not comfortable with this payment, this may not be the right loan for you. And I'm probably not the right person to assist you with the financing, because I'm putting you in a position that I'm setting you up for financial failure.
It's super important to be able to trust your financial team, right? There are absolutely safeguards in place from a federal standpoint as to your debt to income ratios and what you can qualify for. So built into the loan, there should be protections. But more important than that is understanding the client's financial scenario and comfortability in the long term, right? Just because on paper they can afford it doesn't necessarily mean they're comfortable with it. And we see all different areas. I see people that are like, hey, I have a very busy social life. I'm looking to make outside investments. I'm whatever. I have an expensive lifestyle and I need to budget for that as well. I see other people are like, hey, I think that the home is my biggest asset. I work from home. I spend 18 hours a day at home. I'm okay with 30, 40, 50% of my income going towards this asset, right? And so it's understanding the client's long-term goals and leading with the intention of long-term financial success.
I think we have a moral and ethical obligation to our clients, right? Just to shoot straight with them, let them know this is what's going to cost you, especially on the financing side. And me as a real estate agent, what the potential risks are with the purchasing of the investment with regards to the condition of the property, making sure it's fully inspected, all of these details, right? And having the right team that is in alignment with what is right. I think that's the most important thing. And I'm kind of going off topic here when I say this, but one of the requirements that I have for anybody who works with me on my team in my office, this might sound completely cheesy. The number one requirement that I have is that they care.
I don't think that's cheesy at all.
That they give, and forgive the cuss word, that they give a shit. Because that for me is the most vital part. If somebody's inexperienced, I'm okay with that. They'll learn everything that they need to learn.
Experience.
Correct. But as far as the people,
it comes down to human nature, Chris.
It does. And doing what's right, as you mentioned, right? Doing what's right, you provide the information. At that point, they decide which direction they want to take it. But you've done the right thing and letting the client know, I'm here for you. These are the pros and cons. At this point, this is your decision. They decide to move forward. That's their baby.
Agreed. And, we're in alignment there. I think you have to lead with an ethical or moral code. I always pride Olympus on the fact that, all of our loan officers, if you have public reviews anywhere, you have 5 stars. The company has 5 stars everywhere. But more importantly, we want to operate with like-minded people, right? And so even to have a shot at joining our team, we want to know who you are, what your values are, and can we work together? Because at the end of the day, it does come down to more than this being just a career. It very much is part of my life, and I'm sure part of yours, right? To be successful in either vertical of this industry that we're in, it's more than a 9 to 5. It's more than checking into the office and clocking in. It is typically all day dealing with what is for most people the largest investment they'll ever make, what is for most people their largest sense of security that they'll ever have, right? And so there's so many factors into this. If it's just for the money, it's not the right place for you.
I could not agree with you more. So Josh, hopefully our audience has found incredible value in this content. And if somebody's looking to reach out to you on socials, where can they find you?
Oh, absolutely. Thanks for asking, Chris. You can find me at Josh Jankelow on Instagram. We'll include a link here. I'll also give you guys some info on personal contact details with cell phone, email. Feel free to call, text, email. We'll give you our website. Check us out.
Perfect. So what I'll do is in the description, Josh, I'll save you the effort. In the description, I'll put all of your contact information where anyone who's looking to get more information about either working with Josh on the loan officer side, or if you're looking for pre-approvals, you're looking for insight, because Josh can finance anywhere in Florida. Josh, are you licensed in any other states?
Good question. We certainly are. We're in Illinois. We're in Colorado. We're in Texas and Georgia. We plan on being in California in the upcoming months. And we work, like Chris said, in multiple states, but more importantly, with multiple investors. We're not a one-stop, what's your specialty? We specialize in closing the deal. So whether it's first-time home buyer, whether it's a foreign national, whether it's an investor not looking to show income, whether it's a non-warrantable condo, we're the spot to help out.
Great. So Josh could be your contact if you're looking for different types of loan financing in the states that he just mentioned. So if you enjoyed this podcast, I would greatly appreciate if you could please subscribe to my channel. And thank you for following and watching. And one last request, as far as to if there's any takeaways that you had from this episode today, whether it's an idea that you had for financing, what you're using is with regards to in the comments to attract more clients. I'd love to see what you're using and what you find to be effective. And also let us know if there's anything from the financing side that maybe you didn't know before that you learned today. Thank you.